Have you ever seen the headlines about billionaires getting richer and richer and wondered how they can possibly pay less in taxes than you do? Well, it's not some crazy magic trick. It's a playbook. And today, we're going to walk you through exactly how it works.
It really starts with a question that just doesn't seem to add up, right? We all know about tax brackets. The more you earn, the higher your rate. So how on earth is it possible for someone whose wealth is exploding by billions to pay a lower tax rate than, say, a teacher or a nurse?
And look at this. The data really spells it out. The average American household pays around 14% in federal taxes, but the 25 richest Americans, their true tax rate was just 3.4%. Now, that true rate is key. It's not based on their income, but on the growth of their wealth. And the most shocking part? All of this is perfectly legal.
So how do they pull it off? You might think it's buried in thousands of pages of complex tax code, but the answer is actually shockingly simple. It boils down to a powerful three-word playbook. Buy, borrow, die. This is the whole concept that flips our normal understanding of income and taxes completely upside down.
All right, so let's get into the nitty-gritty. How does this buy, borrow, die playbook actually work in the real world? Let's break it down, step by step. Think of it like a continuous loop. First, you buy assets that you expect to go up in value. Second, you use those assets to borrow cash so you can fund your lifestyle. And third, that final step, die, is where the ultimate tax advantage kicks in for your family. Let's dig into each part.
It all starts with a fundamental shift in thinking. Focus on building wealth, not income. You see, our tax system is built to tax what you earn, like a paycheck. It's not really designed to tax what you own. So the super rich concentrate on buying assets, stocks, real estate, art, and then they just hold on. As long as they don't sell, all that growth is called an unrealized gain, and to the IRS, it's basically invisible. Okay, so you've got all this wealth on paper, but how do you actually spend it? This is the crucial crossroads. If you sell your assets, boom, that's a taxable event. You owe capital gains tax. But what if you don't sell? What if you just borrow against the value of those assets? Well, a loan isn't considered income, and if it's not income, it's not taxed.
And this isn't just a theory. People do this all the time. Take Elon Musk. Say he needs $1 billion in cash. If he sells that much Tesla stock, he's looking at a tax bill of around $200 million. Ouch. Instead, he can go to a bank, use his stock as collateral, and get a loan. And we know he does this. SEC filings have shown that about half his shares are pledged for personal loans. He gets the cash and pays zero tax.
The easiest way to wrap your head around this is to think of it like a home equity loan, right? You're using the value of your house to get cash. It's the exact same principle, just on a completely different planet scale-wise. They're basically using their giant portfolios as a personal ATM.
But getting your hands on tax-free cash is only half the story. The final step of the playbook, die, is what makes this strategy so incredibly powerful for building dynastic wealth. I know it sounds a bit morbid, but this is where a huge tax bill can literally just vanish into thin air.
So the borrow part gets all the headlines, it's pretty slick. But what if I told you it's not even the most powerful piece of the puzzle? Some recent research suggests we've actually been focusing on the wrong word in buy, borrow, die. The real magic, the ultimate loophole, happens at the very end.
This quote from Bloomberg Tax just says it all, doesn't it? The real capital gains tax loophole isn't borrowing, it's dying. It perfectly captures this idea that while borrowing is a neat trick, the real structural advantage is built into what happens upon death.
And get this, the numbers are pretty surprising. A recent study found that for the top 1%, borrowing only accounts for about 2% of their economic income. That suggests that many of them aren't even using the borrowing strategy to fund their day-to-day lives. They're living off other income while their main fortune just grows and grows, completely untouched. So for a lot of the ultra-wealthy, a more accurate name for the strategy might actually be buy, save, die. They buy the assets, they live off other income while those assets appreciate for decades, and then they rely on that final step to pass on all that growth completely tax-free.
So how does this final step work? It's all thanks to a tax provision called the stepped-up basis. And honestly, it's like a magic reset button for taxes. When an heir inherits an asset, the IRS essentially pretends that they bought that asset on the day of death for its current price. All that gain that built up over a lifetime, poof, for tax purposes, it's gone.
Here's a perfect real-world example. When Walmart founder Sam Walton passed away, his kids inherited billions in stock that he had acquired for next to nothing. Because of the stepped-up basis, the IRS treated it as if the Walton heirs had just bought that stock for its full multi-billion-dollar value. That entire lifetime of massive capital gains, never taxed. Not $1.
And we are not talking about small potatoes here. This one single provision is estimated to cost the U.S. government over $500 billion in lost tax revenue over the next decade. It is one of the single biggest tax breaks in the entire code.
So naturally, when you're talking about a $500 billion loophole that primarily benefits the wealthiest families, it's going to spark a pretty intense debate. And the big question everyone is asking is, what should we do about it?
And generally, the conversation breaks down into two main camps. One side says we need new kinds of taxes, like a billionaire's income tax, that would tax those unrealized gains every year. The other side argues for a simpler, more targeted fix. Just get rid of the stepped-up basis loophole and tax the gains when the assets get passed off.
And it is so important to remember, this buy, borrow, die strategy isn't illegal tax evasion, it's tax avoidance. It's all happening within the existing rules of a very complex system. These are features of the tax code, whether they were intended to be used this way or not.
So that leaves us with the big, multi-trillion-dollar question. Is this a feature or a bug? Is it a clever part of the system designed to encourage long-term investment, or is it a massive flaw that allows fortunes to be passed down for generations almost entirely untaxed? The answer to that is at the very heart of the debate about wealth in America today.